PepsiCo, stock ticker PEP, is up around 3.6 on the day, which is a lot more volatility than the stock ever sees, and they're now trading $154 per share, and in the last month they're up by about 8%. So what's the reason for the jump up today? Well, it was just reported that Elliott Management took a $4 billion stake in PepsiCo in a major push to make some changes. To be more specific, they did this to make changes to boost its sagging share price. And if we look at Pepsi stock over the last year, you can see what they mean. The stock is down by about 10.5%. If we look at the last 5 years, it's only up by about 7.59%. So a lot of underperformance in the last 5 years. Now, what's so interesting about Elliott Management taking such a major stake in Pepsi is this is reportedly the fund's largest equity position ever. Elliott Management has taken positions in companies like Southwest Airlines and some energy companies, but nothing ever to the tune of $4 billion. And what they believe is possible is they could initiate strategies similar to those taken by Coca-Cola, such as returning company-owned bottling operations to local independent bottlers, or possibly split the company into two entities, food and beverage. Now, whenever we see a major decline in share price over a 1 year or 5 year time period, the question we have to ask ourselves is, why is this the case? Is it purely sentiment? Or is there actually a problem with the underlying fundamentals? Unfortunately for Pepsi, I do think there are some issues. If we go and jump over to our profitability sheet and look at Pepsi, what you'll see has started to happen in recent years is slowing earnings growth and slowing revenue growth. And real quick, like always, if you'd like to download any of these spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. But look at revenue for Pepsi over the last few years. We went from about $86.3 billion to $91.4 to about $91.8. So there's a trend of revenue slowing, and that trend is happening with earnings as well. So revenue and earnings are both slowing. And if we look at the dividend breakdown sheet, this is where it gets even a little more alarming. Now, what we can see is the obvious reason most people are interested in Pepsi. The starting dividend yield is about 3.57%, and obviously they're a dividend king with over 50 consecutive years of dividend increases. And historically, they've done a good job of growing that dividend at a healthy rate. 10-year dividend CAGR, 7.1%. The 5-year, 6.4%. That's decent dividend growth for a stock with about a 3.57% dividend yield. But here's where the concerns start coming in. In 2022, we can see free cash flow did not cover the dividend payout. Again, we have to remember, dividends are paid out of free cash flow. Over the long term, for dividends to be sustainable, you have to generate more in free cash flow than dividends. Now, in 2023, they did pull this off, generating about $7.9 billion in free cash flow, but then in 2024, again, they grew the amount they paid out in dividends, but free cash flow declined. Free cash flow didn't cover their dividends. On top of this, we also have to make note that there are 4 other ways to use free cash flow other than paying out dividends. They can reinvest back into the business, they can pay down debt, they can buy back shares, or they can attempt mergers and acquisitions. And Pepsi is really trying to do all of the above. For example, if we jump over to our stock screener and look at Pepsi, one of the things you'll notice again is they are slowly but steadily buying back shares. Now, this is important to make note of, and they highlighted this in their recent earnings report. If we scroll all the way down to the 4th page, what you'll see is total cash return to shareholders of approximately $8.6 billion. This is in their guidance and outlook. So that's about $7.6 billion of dividends and share repurchases of $1 billion. So the minimum they need to generate in free cash flow to cover those dividends, to cover the buybacks, is $8.6 billion. And if we look last year, the company only generated about $7.1 billion in free cash flow. On top of this, the guidance they gave us is they're expecting a low single-digit increase in organic revenue. They're expecting core constant currency EPS to be pretty much even with the prior year, so no earnings growth. If you're following along, you should be able to see some of the problems with what we're reading right now. Free cash flow is not covering their dividends. It's not covering their share repurchases. And on top of this, free cash flow likely won't be growing at a high rate over the next few years because revenue's not growing and earnings aren't growing. Now, because Pepsi isn't organically growing revenue, what have they turned to? They've turned to mergers and acquisitions, and this is something we've seen them do multiple times in the last year, like with their acquisition of Poppi. And more recently, we can see they struck a deal to increase ownership stake in Celsius Holdings through a $585 million deal. This grew their stake in the company to about 11%. Now again, like I just mentioned, mergers and acquisitions are another way to use free cash flow. So the free cash flow is really getting stretched. It's already not covering dividends and share buybacks, but they're still wanting to reinvest into the business. They're still wanting to pursue mergers and acquisitions. shares. So how are they doing this if they don't have enough free cash flow? Well, it's pretty simple, and it's unfortunate as well, but they're having to weaken the balance sheet. When we look at Pepsi's balance sheet, they're not necessarily in a bad position, but it's not going to be getting better. The debt to assets ratio is currently sitting at about 0.49, so it has climbed a little bit higher in the last 4 or 5 years, but again, not necessarily in a bad position, but it is going to be getting worse if free cash flow is not going to be covering their acquisitions, if it can't cover the dividend, the share buyback. So you can see why people have had concerns about Pepsi for some time now, and I'm certainly one of those people. With that being said, I am actively rooting for Pepsi because even though I don't own it, I do have exposure to the Dividend ETF SCHD, which has a decent allocation to Pepsi. So the news today about Elliott Management taking a stake, I do think is good news. This is not a passive investment into Pepsi. They're looking to aggressively make changes as they make this investment. Elliott Management is an active investor, so I'm not really all too surprised to see a little bit of a jump up today, currently up about 3%. Now again, what does that actually say about the stock? What does the valuation look like at current prices? Well, because Pepsi's in a unique situation, here's what we're going to do. We're going to look at them through the lens of a dividend discount model, but actually a reverse dividend discount model. If we plug in Pepsi, we'll come over here and look at our dividend discount model. Now, the idea behind this is quite simple. The dividend discount model tells us how much a stock is worth by looking at how much they're paying out in dividends and how much they're going to pay out in the future. So in the case of Pepsi, if we assume 0% dividend growth moving forward, the stock would only be worth about $64.56 per share, which is about 57% less than the current share price. So what does that tell us? Well, the market is pricing in dividend growth. But just how much? If we bump this up to 2.5%, stock is worth about $93.74. If we bump it to 3.5%, it's worth $113. If we bump it up to 4.5%, the stock is worth about $143 per share, and if we bump it up one more time to 4.75%, the stock would be worth right at the current share price, only off by about 0.3%. Now, the question you would have to ask yourself to determine the actual valuation for Pepsi is, do you think this number is justified? If you think Pepsi can achieve this dividend growth, or if it'll be even higher, then the stock could be undervalued, but if you think it'll be lower, then the stock is probably overvalued. For me personally, I do have my worries about Pepsi being able to achieve this. Now, in the short term, they can certainly continue to grow that dividend at around 4 to 5%, but they can't do so without continuing to hurt the balance sheet. Whenever a stock is growing dividends, it's extremely important to look and see whether or not that dividend growth is actually sustainable. And the way we do that is by looking at the free cash flow payout ratio over time. If a stock is growing its dividend, but that free cash flow payout ratio is continuing to climb higher, then that's not technically sustainable dividend growth. That's such an important concept to understand. So Pepsi is definitely facing some headwinds, and they're likely going to continue to do so, especially based on the guidance that we just saw that management is giving us at least through the year 2025. But I do think the news today is overall good news. I'm actively rooting for Pepsi, but I certainly don't plan on initiating a position, especially when I think there's better opportunities out there. So go ahead and let me know what you think of Pepsi stock in the comments down below. If you'd like to get a 7-day free trial to Seeking Alpha or to any of my spreadsheets and ticker data, then you can do so at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.